Hi everybody, today I'm going to share with you 3 fixed income products that are fully backed by the Singapore government and that allow you to earn regular incomes or dividends. They are called the Singapore Government Securities Bonds, Treasury Bills, and the Singapore Savings Bonds. How to know about these 3 products information? You need to go to MAS website. Under the MAS website, you just need to click on the Bonds and Bill tab, and it will lead you to a page to show you there is 3 products that's offered by the Singapore government for investor to invest in. Now let's look at what is the difference between SGS bonds and T-bills. T-bills are short-term debt instruments issued by government that will mature within 6 months to 1 year period. But while SGS bonds will be issued by the government will have maturity from 2 years to 30 years. So the key differences is mainly the time. Okay, one is less than 1 year and one is 2 years and above. Singapore government have been regularly issuing T-bills and SGS bonds on a regular basis, and you can say that it's a monthly affair. And how to find this information is from the website. You'll see that there's this thing called auction update, and where they will tell you that what is the upcoming T-bills or bond that open for investor like you and me to invest in. Okay, from this table you can see that actually 2 of them already closed. That means that one is on 25th of November, which is today where this video is recorded, and it's still open for investment, and you can actually click in to see more details. And you want to see the futures one, then you can just go and look at the auction calendar. You're able to see all the SGS bonds that we're going to plan to be issued and the T-bills that were going to be issued, of course with the Singapore Savings Bond. So you can find all this information on the MAS website. So now let's look at how can you purchase these SGS bonds and T-bill when it's open for auctions. The first criteria, you need to have a CDP account and also a local bank account, either DBS, POSB, UOB or OCBC. With that, you need to log into the internet banking. This example will show you how you use DBS to do it. You just need to go to the invest portion and look for Singapore Government Securities, we call SGS. Okay, and when you click on it, you'll let you choose whether you want to subscribe for Singapore Savings Bond, T-bills or bonds. For this example, I show you that we're going to subscribe for the T-bills. Currently for this T-bill is only for cash only. You are not allowed to use SRS to invest. Okay, when you click on it, then you move on. But what is the method of sales and how to buy this thing after you click on it? Practically, there is 2 key methods. One is called the non-competitive bids, and the other one is called the competitive bids. What do you mean by that? Non-competitive bid means that you will just want to buy the bond regardless of the yield. Regardless of it. That means you only say that I want to invest in how much. So the yield will be determined by the auction result. And this is where you will get the bond based on the cut-off yield. However, it is capped on 40% of the total insurance amount. So if too many people go for non-competitive bid, then they will be subject to allocation. If it's less than 40%, you will usually get full allocation. The next is competitive bids. Is you will want to bid for it, and you want to bid for the yield you want, then you want to buy the bonds. So there is 2 ways you can choose this. One is called a competitive bid and one is called a non-competitive bid. From the left side, you can see for the competitive bid, you can submit the yield you want to bid, but for the non-competitive bid, you only need to specify the amount you want to invest. You are not allowed to key in the yield you want to bid for it. So this is the 2 differences between what you want to do. But do take note, there is a $2 transaction cost imposed by the bank, and the minimum investment amount is $1,000 up to $1 million. After you submit a bid already, when the auction is closed, they'll announce the cut-off yield. What happens if the cut-off yield is lower than the coupon rate. That means you are indirectly buying the bond at a discount. And what the system will do, they will refund you the excess amount you pay. What happens if the cut-off yield is more than the coupon rate? That means you are buying the bond or the T-bills at a premium, and they will deduct extra money from your bank account to top up for the difference. Let me show you this example. This is a bond that I've just closed recently in October. You can see that for this 5-year bond, the coupon yield is 1.25%. And after the auction result is out already, the cut-off yield happened to be 1.37%. So this means that the cut-off yield is higher than the coupon rate, and thus the price of the bond will be lower. That means you are buying the bond at the discount where the bond is supposed to be $100, now become 99.422, and thus the government will credit you the difference in amount back to your bank account. Okay, because you will still get 1.25% coupon rate. So this is where we say that the cut-off yield is higher than the coupon rate. Okay, let's look at another 5-year bond that is happened to be in May, where the coupon rate is 2.125%. This closing year and closing price is current trading price. So let's look at the point of time, what is the cut-off yield. At the point of time in May, what is the cut-off yield? The cut-off yield is 0.89%, which is much lower than the coupon rate. So that means that you are buying it at a premium, and the cut-off price is 106.025, and thus they will go to your bank account to deduct more money from your bank account to pay for the extra premium. But one thing to take note, that when you want to buy these SGS bonds or T-bill, usually meant to hold to maturity. Okay, however, along the way, if you decided to cash out, or we call early redemptions, do take note that you may have an issue in redeeming it. You can go to the 3 banks, okay, to do the redemption, or you need a brokerage account to sell it off to a third party. It will become like buying and selling shares, where you can sell it off in the open market. However, do take note that there will usually be some liquidity issues when you want to do early redemption of SGS bond or T-bills. Let's look at this example of all these bonds that have been issued in 2021 from January to October. You can see, let's look at the current price. You can see that the market price, practically there is no trading volumes for the bonds that you want to sell. And when you look at the market depth, for example, you can see that it is very thinly traded, and practically there is no buyer or seller for the bonds. Thus, do think of, if you were to commit yourself to buy the Singapore government's bonds and the T-bills, you are supposed to meant to hold to maturity. It's just like put money in a fixed deposit for long term, and you just put it there and forget about it, and until maturity you get back the money. Because if along the way you want to sell it off, you will face this liquidity issue, and you can see the bid offer spread can be relatively big. The third type of Singapore-backed bonds is called the Singapore Savings Bond. I think this one, many of you are quite familiar with this. It issued on a monthly basis, where you can use your cash and SRIs to invest in. The minimum investment amount for this is $500. But do take note, there is also a $2 processing fee charged by the bank. And for this bond, it is a 10-year bond where the interest is based on a step-up rate. So the application method is still the same as per the T-bills and the bond. You just need to go to your internet banking or ATM machine, either DBS, OCBC or UOB banks, and you can apply for the Singapore Savings Bond when it's open for application. And usually the application is close to about 1 month, because every month there is a new bond issue out. This is just an example, and this is where the service charge of $2 is imposed on your bond. Okay, the $2 is fixed, so if you buy $500, you pay $2. If you buy $10,000, you also pay $2. So this is something you need to take note of that on the cost of investing. What happens if you want to sell this Singapore Savings Bond? For this one, you are allowed to do early redemption at no loss. What do you mean by that? It means that you just need to go back to the internet banking to click the redemption button of this Singapore Savings Bond, The redemption period is usually on the 1st to 4th business day of every month, where you can submit your redemption. After that, they will give back you your principal plus the accrued interest you earn. So what does it mean? It means that the Singapore savings bond, you no need to lock in for 10 years. If along the way you need the money, you can cash it out within the redemption period. And after that, you will not have capital loss also. And they will still pay you the accrued interest. So this is a summary of the 3 Singapore-backed debt security, the SGS bonds, the T-bills, and the savings bonds. And you actually can find this information on MAS website, where they also have this comparison. That's all I have to share with you today, and if you feel that this video has benefit you, do remember to like and share, and also leave your comment below to let me know what you think about this. And also do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.